Welcome back. Let's get into some market news now. Asian markets on Monday built on last week's rally as investors cheered a report that China had offered to eliminate its massive trade surplus with the United States, while data showed that Chinese economic growth hit forecasts in 2018. It's still the lowest rate of growth in 28 years, 6.6% for the world number 2 economy. Oh, we can only dream of such growth right now. Regional equities, however, picked up where they finished on Friday after Bloomberg said that Beijing had pledged to ramp up spending on U.S. goods over the next 5 years. Now, while there was some skepticism over the offer, observers said it indicated that talks between the economic superpowers were indeed heading in the right direction. It may not have been much, but the Asian markets edged up, with the Nikkei gaining 0.33% to 20,719 points. Hong Kong's Hang Seng moved 0.4% higher to 27,196, while the Shanghai Composite was 0.33% better at 2,610 points. Over the United States, stocks rose on Friday, helping Wall Street's major indices advance for what was a 4th consecutive week, as increased hopes that the United States and China would resolve their trade dispute lifted shares across sectors. Now, the Dow Jones Industrial rose 1.4% to hit 24,712 points at close. The S&P 500 moved 1.3% higher, ending the day at 2,671, while the Nasdaq Composite gained 1% to end at 7,157 points. Now, the market has been tumultuous. Really great trade, however, coming through from Friday on to today. That's a lot more, considering, of course, the fact that that China-US trade talk is the main issue, and a lot of people perhaps concerned about that. Asia doing well, and that's despite that growth figure of 6.6%, which is indeed the lowest in 28 years, but is to be expected. So it did come through in accordance with the forecast, so it perhaps might not move markets too much on that kilter. But let's take a look at the numbers and see exactly what's going on with the local and European numbers. Well, as you can tell, the market, they're fairly green in most areas, but of course, there will be big fears as to what exactly happens out in China, that U.S. trade wars. Well, Brexit is still a factor, of course, and something to certainly look out for. Let's chat to Gary Boyson, who is portfolio manager at Rand Swiss. They're joining us this afternoon from the JSE. Gary, thank you so much for the time this afternoon. 0.2% to the good, following on from last week, which seems to be getting better week performances. Is it just that it's from a low base, or is there really some good news coming out in the world now?
It does feel like there's a little bit of optimism returning to the global economy as well. Certainly, I think there's optimism that we are going to reach a positive conclusion on the US-China trade talks. We do have the US closed this evening for Martin Luther King Day, so that will be taking some of the volume out of the market. But certainly, so far, it's been a good January. It looks like the Christmas rally is here, just a little bit later than we expected.
Yeah. Well, it is, as you said, delayed, if you want to call it that, fine. But you do have that US-China trade talk, and that situation seems to be now headed in the right direction. China perhaps even considering cutting away their entire trade surplus with the United States. That is very, very huge. That could really move markets in another way, in one way or another. How positive is this for the US and perhaps then for global markets?
I think every analyst has been keeping a very close eye on Chinese numbers recently, and trying to almost extrapolate what this means for the US-China trade talks. So if you look at the GDP numbers today, as you said, it was in line with expectations, but it was weaker than last time. And I think we are starting to see some of the impact of the various tariff barriers increasing, playing out in the real economic numbers. So that in itself, I think people are now assuming that this could potentially lead to maybe a softer stance from China. Again, you're looking at the US data and thinking, any kind of miss on numbers there could potentially just see a softening of attitudes and, perhaps more friendly trade talks. And that in itself has kind of almost flipped the dialogue. It's almost like when you look at Fed hikes and you think that, when you get a bad set of numbers, you suddenly think, oh, this could instigate a policy change. And suddenly the markets react positively to fairly weak numbers.
Yeah. Let's say then that the trade issue is resolved and everything comes back online. Does that change that GDP number then particularly for China? Does it perhaps increase it ever so slightly? Because they did cite that trade talk and that trade situation as the main reason for this number going to 6.6.
Yeah, so if you look at it, 6.6 was the annual number for 2018. We had a 6.4% print for the last quarter of the year. And again, that was in line with expectations. We actually saw the industrial production figure ticking up ahead of expectations. We were expecting a decline there, and we actually got an increase. But again, you need to put these Chinese numbers in context. So if you look at it, we're looking at about a $13 trillion annual GDP coming out of China. If you look at South Africa, we're sitting on the 2017 numbers at least at about 350 billion. So if you have a look at that, you've got to also just put that in context and say that China every year at a 6.4% growth rate is adding more than 2 South Africas to its economy. And now think about us in terms of BRICS. Brazil, Russia, India, China, South Africa at the end. China, one of the partners in that organization, is adding 2 of us every single year. I mean, this number, just because of the size of the Chinese economy, is actually still incredibly impressive.
Yeah, I suppose that is the whole big thing there, that it is actually still massively impressive in comparison to South Africa. Wanted to quickly just touch on that oil price, a little bit above that $60 a barrel mark. Anything to be wary or worried about on that front, do you think?
Yeah, so we're seeing some disruptions to supply coming out of Libya, which is helping to lift the oil price a little bit. It did trade, as you said, briefly through the $63 barrel. There's also concerns around supply disruption in Nigeria, and we're also seeing lower stockpiles coming out of Venezuela as well. So some at least not lower stockpiles, lower production numbers coming out of Venezuela. So all of that kind of feeding into the idea that this global supply glut might not be as bad as expected, and we're seeing the price a little bit higher on the back of that.
Yeah. If we touch on to some equity news, then you had ABSA as well announcing that it was going to be joining up or buying some parts of Societe Generale in order to get into the rest of Africa. Now, my concern here is that we've just let go of Barclays, and it does seem that they continuously need a leg up to make that Africa business work. Are there concerns for ABSA?
I don't think it was a messy divorce from Barclays, but certainly ABSA on the rebound, picking up partnership with SocGen. And if you have a look at it, it does seem to make sense. So some of the concerns around when ABSA parted ways from Barclays was the ability to service their multinational client base. Now with SocGen obviously coming to the party, that's going to vastly expand some of ABSA's potential services, especially in CIB, so the corporate and investment banking. And again, you also look at the footprint between ABSA and SocGen. ABSA very much focused on the English-speaking countries in Africa, so southern and eastern regions, whereas SocGen coming from obviously a French background in the French-speaking parts, which is the west and the north. So it does seem like a partnership that's going to make sense. It's at the moment we've just got a memorandum of understanding, so it's not a full-blown agreement. It's not yet a marriage, but certainly it looks promising, I think, for the business.
Yeah. Gary, appreciate your time, but hopefully we'll continue the conversation as well and checking in on how things are faring out in China, of course, locally as well. Appreciate your time. That's Gary Boyson's portfolio manager at Rand Swiss. We continue to unpack not just the markets, but this time South Africa's economy. Where exactly do we stand when it comes to the South African Reserve Bank? Are we changing the mandate? Are we perhaps tinkering with just the fact that growth or fiscal economics needs to meet with monetary policy? We'll unpack that after this short break. To stay tuned.